Well, in today's video, we're going over 4 reasons that you may want to avoid traditional TSP. If you avoid traditional TSP, I guess that means you're going to need to use Roth TSP instead. So let's talk over why you may want to do that coming up next. Hey, this is Tommy Neesmith. I'm a financial planner with Christy Capital Management, where we're helping federal employees prepare for their federal retirement. If you need help, go to christycapital.com and click Talk to an Advisor. Well, today we're going over 4 reasons of why you may want to avoid traditional TSP and what you may want to do instead. So the first one is potential future tax increases. With traditional TSP, you get a tax deduction now when you contribute the money. You get the tax-deferred growth over time, but you have to pay taxes when you take distributions in the future. And you have to pay the taxes on whatever the tax rate happens to be in the future. Potentially, those taxes could be worse, and if they are worse, that would make traditional TSP not have been the better choice. If you are of the belief that 10 years from now or 20 years from now, tax rates are going to be much higher, then Roth TSP will be the more attractive solution than traditional TSP. So the first reason you may want to avoid traditional TSP is that you think future tax rates are going to be worse. Well, let's look at the second reason to potentially avoid traditional TSP. And it's that eventually there are mandatory distributions. At some point, you'll be forced to take money out of the account. Now, required minimum distributions begin at age 73 or age 75, depending on the year you were born. The beginning distributions are around 4% of whatever the balance is, and you have to take the money out each year. You have no choice. And it's taxable. So whether you need the distribution or not, the distributions are mandatory. The third reason to potentially avoid traditional TSP is even after your death, the distributions will be mandatory and taxable. So if your spouse inherits your traditional TSP, or traditional IRA for that matter, they can roll the money into their own account, and they have to take annual distributions if you've already started your RMDs. And of course, they'll be taxable. If you have a non-spouse beneficiary, there's a 10-year rule where they have to take a minimum amount out each year, and the full balance has to be withdrawn by the end of the 10th year. All of these distributions will be taxable. So just like our second reason with distributions being mandatory even after your death, the distributions are mandatory. Now, the fourth reason to potentially avoid traditional TSP, especially for federal retirees, is that you probably are not going to be in a lower tax bracket. The theory behind using traditional accounts is that you're going to get a deduction during your working years when you're at a higher tax bracket. And then you take distributions when you retire, and maybe you're at a lower tax bracket. For instance, you took the tax deduction when you were in the 22% tax bracket, but then took your distributions in the 12% tax bracket. That would be using traditional savings as it was intended. That's the benefit of using traditional. But what we find working with federal employees is that when you account for the federal pension and your Social Security and your spousal Social Security, lots of times, well, you're in the same tax bracket. There's not a dramatic drop in taxable income. Now, this can happen for lots of reasons. Many of the deductions that you've used throughout your career, well, they've gone away. You're no longer contributing to TSP and getting that deduction. Your federal health care is no longer tax deductible. Your children have grown up and moved out, so you don't get that deduction. Losing those deductions causes your taxable income to be higher. And then what's actually disheartening is when you don't really need to take distributions from your TSP, and so the account grows and grows, and by age 73 or 75, when you take out your RMD, well, sometimes that can cause you to shift up in a higher tax bracket. Well, and then if we circle back to reason number 1, what if 20 years from now, the tax brackets are actually worse? Well, that's a double whammy. Your income could push you into a higher tax bracket. And then the higher tax bracket could be worse just because taxes happen to be worse. Well, what can we do about these issues? And does Roth fix all of them? Well, let's go through each one and see. So the first issue was potential tax increase in the future. Would Roth fix that? Well, yes, it would. If you had done a Roth all along or shifted your money to Roth before there are tax increases, then yes, Roth would help fix it. The taxes would have already been paid, so an increase in tax would not affect your Roth account. Well, what about the next issue? Distributions that are eventually mandatory. So with Roth, there are no required minimum distributions during your lifetime. The money can stay in the Roth account, continue to grow without having forced withdrawals. So during your lifetime, there are no forced withdrawals. The next issue, after your death, there are mandatory distributions. Well, Roth fixes it for your spouse. Your spouse can roll the money into their personal Roth IRA and not have any RMDs. It does not fix it for non-spouse beneficiaries, as they will have to abide by the 10-year rule, but distributions are not taxable. So it sort of fixes the problem. There are distributions forced upon non-spousal beneficiaries, but they are not taxable. And then the last issue with federal employees getting bumped up to a higher tax bracket when the RMD kicks in, it would fix that. There are no RMDs with Roth. And even if you choose to take distributions, they would not bump you up into a higher tax bracket because the distributions are not taxable. So for most of the potential issues with having traditional money, Roth helps fix them. So let's say you're 60 years old and the majority of your money is traditional and you're thinking, yikes, I don't want to keep it like this. What can I do? Well, if you're still working, you can start contributing to Roth TSP. If you're 59 and a half and over, you can move your TSP out into an IRA and begin doing Roth conversions. We have lots of videos on Roth conversions. If you need help doing that, please reach out to us. That is definitely something that we help clients figure out and accomplish. Figuring out the tax issues or potential issues is key. Proactive planning can combat a lot of these issues. If you have retired or separated from service, no matter what age you are, you have access to your TSP and can roll it to an IRA to do Roth conversions. Now, clearly Roth conversions are an important planning tool, but can you mess it up? Well, you can. So check out this video right here, 6 Roth IRA mistakes. Just like there are some issues with traditional, when getting money to Roth, you can do it correctly or you can do it incorrectly. Well, if you want to talk to an advisor one-on-one, go to christycapital.com and click Talk to an Advisor. My name is Tommy Neesmith, and I'll talk to you soon.